So this is our third year doing this report, and really our goal is to just take a step back and see where are we overall in the software journey. The slides are actually on cloudnewyork.com if you want to follow along. We've actually got a much longer version on the website. This is going to be a kind of half the version we'll go through today, and we'll get going. So this is from our lawyers. Do you see that? So you might be wondering, with NASDAQ and with where multiples are, right, is software overdone? Like, is it all kind of downhill from here? And I'd make the case, and I'd still make the case if you zoom out, we are still very early in the software adoption cycle. And we continue to be very bullish on software. SaaS is growing at 18%, 6 times GDP. And we don't see this slowing down because there's a bunch of positive things that are kind of, it's a rising tide environment. And in fact, we have a framework, we call it the 5 forces that continue to provide this rising tide. I'll go through each one of these quickly here. The first one is kind of the core software market is basically continuing to attract more seats. So with mobile penetration, you just keep adding more and more seats into core software. And historically, software has been really about Fortune 2000 horizontal applications. And over the last 5-10 years, and for the next, I think, couple of decades, really the SMB market is going to enjoy all the benefits of software that Fortune 2000 companies enjoyed. And that's going to grow the market overall. And then a bunch of, in addition to the SMBs, a bunch of verticals now are coming online. And then you've got these really interesting examples. I think DocuSign is probably one of the best examples of a hyper-focused business process that created an entire market, $10 billion market cap or whatever they are, around that function. And that didn't exist in the past. Software continues to steal market share from hardware. You can see the, kind of the growth rate here for cloud IT infrastructure. The reality is that value keeps accruing to the top of the stack, and this will drive growth in the software market. John talked a little bit about this today, but really software is capturing more of the market from labor. Kind of at the highest level, I think of it as an epic battle between labor and software, and software is going to just continue to chip away at labor markets, and that provides for all of us kind of a nice backdrop. So, we see this with RPA and automation in general. And lastly, every company is really becoming a software company. You see that as the economy becomes more digital, more of it really is software-based. And if you look at the names on this list, these are all folks that are trying to get involved in software and reinvent their businesses. And what's interesting is that at Battery, we have found that 30% of our exits, 30%, now come from buyers that are non-traditional software buyers. We sold a business called Mendex to Siemens last year. We sold a software company to a company called ResMed. You put Roper, Danaher on this list, Fortive on this list. And this is a new wave of buyers trying to kind of build their software assets and really take advantage of the software wave. So when we look at the software market, we continue to think the curve is going to look like this curve, where at any point in time, if you looked at it and you look historically, you'd be saying, wow, this is kind of a local maximum. But if you kind of zoom out, I think you'd reach the conclusion that really this market is just going to continue to grow dramatically from here, and we're still kind of the early cycle. So with that as backdrop, I just thought it'd be good to get into some of the specifics around the venture market, IPO markets, and M&A markets. And the headline is 2018 was a banner year for basically everything. It's like kind of an amazing year. So if you look at software investing last year, software, $45 billion was invested in just software last year. Obviously, significant growth from prior years. We're kind of stuck at 30 billion, and this is like 5x in the last decade. So we're continuing to see a lot of money come into the market. Now, it is interesting to note that the number of deals continues to kind of tick down. And so, the obvious conclusion is there's more dollars going into fewer deals. And I think there's this winner-take-all dynamic that's happening that's kind of showing up in a bunch of slides, but this is kind of one area where that's showing up as well. And we've looked at this actually across every geo in the US, as well as internationally. In every single market, it looks like this. They're all kind of up and to the right in terms of software dollars. And there's some interesting trends around round size. Basically, if you look at the A's and B's, and next page we'll have C's and D's, you can see the round sizes keep going up. That's the bar. That's a line chart, and the valuations keep kind of grinding up. But the dilution level is actually more or less flat for the A's and B's. And interestingly, for the C's and D rounds, even though the check sizes are increasing quite a bit, the dilution number is actually coming down. So this is usually when founders are very happy, when they hear they can have more money for less dilution. Okay, we got that. All right. But yeah, I'll tell you, the thing that I find interesting is we are seeing a lot of Series C's rounds that are 30, 40, 50 million now. Never happened before. It was like 20 million used to be a big number. And D rounds where 50 to $75 million rounds are just kind of common. So if you put it all together, A round at 10 million, B's at 20 to 25, C's at 30 to 50, D's at 50 to 75, and E rounds at 100, you're basically talking about 200 million of capital over kind of 5 rounds. So that's a lot of capital that's coming into the market. The good news is the dilution level for the founders is about the same as it used to be. But as I'll get through some of these slides, it does require, I believe, kind of a different playbook to put that capital to work to win your respective markets. And I want to go through some of that. Let's talk about the IPO markets, and I'll come back to some of the operational implications. So 2018 was also a record year for dollars raised in the IPO markets. You'll see about $5 billion raised compared to $2.5 billion in 2012. But what I find the most interesting thing here is the size of the company at the IPO point. So it's the second row from the bottom. You can see that the class of 2018 is around 200 million, plus or minus of revenue at the time of IPO. But look at it just 3 years ago. 3 years ago, it was $100 million. And that's a very different point to go public. I think this is actually, in some ways, very good, partly because I provide private capital, but also companies are more mature when they go public. They're going to be north of $1 billion in market cap. At this point, being a public company, sub-$1 billion market cap is a terrible place to end up. There's no coverage. So this is goodness for, I think, capital markets and the software markets overall. But it does require thinking about how to build your business to this point. And let's look at this class of 2018 just in a little more detail. So as I mentioned, the first circle there, you'll see a couple $100 million of implied ARR at the time of IPO. But kind of come over to the right side. And what you see there is that the typical company at the time of IPO has raised $300 million. It's like staggering. That is a lot of money. And you look at the time, 13 and a half years to get there. And the average ARR per employee, which I'll come back to, is about a couple 100,000. So if you look at that, that kind of computes to roughly about 1,000 employees at the time of an IPO. And so having the mindset, the ability, the team to run a 1,000-person organization is obviously different. And I think this is really important in the sense that just a few years ago, we were instructing our companies, hey, look, here's the playbook. Get from 2 to 100 million in 5 years. In fact, we had a saying called T2, D3, triple, triple, double, 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 and things would work out. But the game on the field is totally different now, right? We're talking about getting from 2 to 200, maybe in 10 years. So there's another phase that's coming that needs to be thought about prior to the IPO. And so there's implications. The first one obviously being there's going to be more rounds, more capital. But I'll tell you the second one, we're seeing this in a lot of our companies, is thinking about employee option pools, refreshes. When vesting started, the idea was there's a 4-year vest. And most companies went public in 5 years. So there was never this real concept of a refresh grant. But now, a 4-year vest with a 10-year window means we're all going to be dealing with refresh cycles. And everyone in this room is pretty smart. You do 4, 5, 6% option pool dilution every year times 10 years. That's a lot of dilution. So you have the pie has to get bigger to kind of make up for that level of dilution. And the framework for when do you do refresh, how much you do refresh, is going to be an important topic for all of us to figure out. And lastly, I would say that founders really need to think of building out their extended teams to get to 200 million. That's just requires, sometimes founders enjoy doing that, sometimes they don't enjoy doing that. I think we're seeing a lot of COOs come in now in that 100 to 200 million phase. CEO coaches, operationally oriented independents. We recruited John Chambers to the board before that we talked about. But things like that are happening now because to go public, you need to be at 200 million. And we see that the 100 to 200 million phase is kind of a different mindset for most founders. All right, let's transition, talk about multiples. So multiples are obviously very frothy. You can argue that we're based again at maximums. Being an investor, and I'd argue being a founder in the last 10 years, in some ways you could argue was pretty easy. If you have a rising multiple environment, you generally look pretty smart, When multiples plateau, and it's hard to predict if this is it, but it feels like it. And if they come down, it's a lot tougher to create value in that environment for all of us around here. And these multiples are just, we were talking to Jeff from Catalyst, about some of the deals he's working on. It's just creating a lot of interesting dynamics out there. And you see, this we've never seen before, where you have this. It used to be 10 times forward was like kind of unheard of. That was like aspirational. We have companies now at 20 times forward. And some recent IPOs at almost 30 times forward. So this is changing a lot of behavior, especially in the venture markets, where if you're an investor in the private markets and you think you have a shot at being one of these companies, you're willing to pay more, raise the higher rounds. Therefore, the founders need to put the capital to work and try to win their category. And so playing to win requires, again, I think, a more aggressive mindset than in the past. And public markets are clearly valuing growth, but over the last few years, a really balance between pure growth or growth at all costs and, in essence, a rule of 40 with growth and free cash flow in mind. Let's look at the rule of 40 for a sec. So in the slide on the left, you'll see the green and the red, and basically that's just the rule of 40 line. And it's, I think, really interesting to see the difference in multiple between these two buckets. So you have 12.8 times forward versus 8 times forward. But we also kind of looked at it from if you kind of added growth rates. So we call it the 4 zones. If you look at the right side, it's above and below the rule of 40, and then the horizontal line splits the growth rate. And you can see the green box is the best box, where you're above the rule of 40 and you're growing above 30%. You're at 15 times. But what's interesting, the second best bucket is actually the blue one, where you're below the rule of 40, but you're growing above 30%. And then the yellow and the toughest one is the red one, where you're below the rule of 40, growing less than 30%, 6 times. So the goal is for all of us to end up in the green zone. So, all right, and then you can see some of the companies here that are in these different buckets. Give you a sense of some of the names. And if you say, look, hey, if the rule of 40 is something that's important, then I would argue that CEOs in the room need to really start thinking about revenue per employee as kind of a key metric as they build their business. And we were surprised by this. If you look at the slide on the left, there's over $100,000 difference in revenue per employee for folks that are above the rule of 40 versus below. Less correlated to growth on the right side, but that's a pretty big delta. And if you think about how do you get there over time, I kind of think of it as a board member, really, it's these kind of phases on revenue per employee where, you're finding product market fit, you're over-investing theoretically, trying to get to 10 or 20 million in ARR. At that point, you're pretty inefficient. And then you end up in this investment phase, this kind of 100 to 200K of ARR per employee. And this is the bulk, I think, of the private phase of a company. But many times I find that founders sometimes get stuck on the 100K number, not thinking about what do I need to do to get to 150 or 200, not next year, but over the next 3 years, 4 years. and building that mindset. Because if you don't do it, you're never going to end up above the rule of 40. It's just mathematically not going to happen. And then you get to this IPO phase where you're at this 200 to 300K phase. Break even, I would say, is about 250K is kind of the rule of thumb I use. When I started in venture 20 years ago, it used to be like 175. So just inflation and wage inflation has taken us there. But it's very dependent on geography, go to market motion. But round numbers, 200 to 300. And then you end up in the sustained profit zone of 300 to 500K range. And just to give you a sense, Salesforce is at 400K, Atlassian's at 375K. And if you actually, and those businesses are about 25% free cash flow margin. So over time, we all kind of need to move through these phases and start building that mindset. In case you're wondering, if you have a monopolistic business, like Google or Facebook, they're at between $1 million and $1.5 million of revenue per employee. So it's a good place to be. All right, let's talk about the M&A markets. Again, 2018, record year. You can see 175 billion, almost 3x prior years. But this next page is, I think, kind of says it all. Where last year there were more billion-dollar plus SaaS deals, just 1 year compared to the prior 4 years combined, and it was just a record from that perspective. And if we look at it by the various strategics, this is interesting also that you've got 8 of the top 10 all-time multiples paid happened last year. 8 out of 10 of them. And obviously, 15, 16 times for MuleSoft and Qualtrics. Now, all that's happening, but if you look at this page, and again, this is from our friends at Catalyst, you see that it's not the same story at every buyer. Workday made their first acquisition last year, and historically not been very acquisitive. ServiceNow has really done nothing. Amazon's really done nothing. Google's bought one thing, kind of enterprise. Now, that might change with Thomas Curry in charge, but basically half of these buyers aren't really active in the markets. And you've got another couple that are kind of struggling, have a hard time paying anything. Microsoft, I would say, is very thoughtful in their approach of what to buy. But basically, there's 4 or 5 names, and for any given company here, it might be 2 or 3 names that you could really talk to on this list. So the takeaway for me is it's really important to build these relationships with a couple of these folks, but also think about 1 or 2 buyers that are non-software companies, like the list we had before, the Fords of the world, the Danahers, because they continue to come to the market, and they can be one of your 2 or 3 bidders, hopefully, in your process. And as I mentioned, 30% of our sales actually happen to that non-software buyer list. Now, I'd say the other good news is the number of billion-dollar plus public companies keeps growing. So there were 64 of them. But really between $1 billion and $5 billion, it's hard for those companies to buy anything of scale. And so the bottom line shows that there's 29 companies that are now public companies north of $5 billion. And these will be the next set of buyers. So as they mature to 10 billion, they will provide the additional competitive juices for acquisitions. And I would argue that Twilio SendGrid really is kind of the first example of this next wave of buyer coming into the markets, creating kind of more and more M&A interest. All right, so we covered venture, public, and M&A, all hit records in 2018. Let's kind of quickly just talk about a few themes. First one is probably overhyped, but we are seeing quite a bit of automation and AI really kick in, where companies that have this as their core competency are wedging into traditional horizontal workflow and making kind of significant impact. The other thing that we've observed is that there really is this like massive battle happening for developer mindshare. And you look at the amount of market cap that's floating around that wants to own the developer's heart and mind. Last year was a great year for this. You see Microsoft's acquisition of GitHub. We personally saw it at Battery when we sold a business called Opsgenie to Atlassian. And these folks are going to make it very clear that they want to own the developer, and there's a lot of value that they're willing to assign to that. And now open source had a huge year last year, and it really plays into this developer mindset because many of these companies, they have a nice motion going into the developer, but with Elastic, GitHub, and several unicorns in open source, all happening last year, I think 2018 was kind of a key watershed moment for that market. And another theme that we're seeing is that really kind of the shift from sales-centric software companies to product-centric companies. And I think this has a bunch of implications. First one is really, what does the P&L actually look like? And if you look at the Salesforce P&L compared to the Atlassian P&L, it is dramatically different. You have Atlassian spending 48% of revenue in R&D, Salesforce at 15%. And it's almost the opposite for sales and marketing, where Salesforce spends 46%, Atlassian spends 22%. What will the future software company look like? Does it look like the left, or does it look like the right? And I'd make the argument that it's going to look more like the right over time. And these two functions are going to continue to kind of flip-flop in terms of importance. And that also has a lot of implications. I would say we've seen product management changing, because as you invest more in R&D, the way you think about product matters. And product management historically was very not data-driven, very gut-driven, like marketing used to be. And a lot of marketing automation came in and made that discipline very data-driven. And we're seeing the same thing happen now with product. This is from our friends at Pendo. It still kind of shocks me that 80% of the features that are developed in a software product either rarely or never get used. Just think about that for a second, okay? The scarcest thing in the economy is software development talent. None of us in this room can hire enough software developers. Yet, 80% of what they build is not being used. Why is that? How could that happen? And it's because product management historically was just a gut-driven exercise. And this is going to become much more data-driven. If you compute the economic value, I think $37 billion was spent in R&D at public cloud companies. 80% times $37 billion is $30 billion. That's not being spent well. So I think this is kind of a huge problem that will get fixed as product becomes more important. And another kind of implication is really the sales motion is becoming more bottoms up. And last year was a big year for that. I would say the biggest mistake I made as a venture person in the last decade is underestimating this. That you'd ask me, I'd say, oh, you need a sales team, you need field sales. That's the only way to sell into enterprise. Totally wrong. And this motion, we've had more companies in our portfolio, but we're learning this mindset in this approach to selling. And it really is a sales approach, but it's as much a product approach on how do you get viral loops into your product, how do you get expansion built into your product, how do you get shareability built in your product. And I think there's a lot that we can learn. Even if you're totally Fortune 2000 enterprise field driven, this mindset to product management, I think, is going to have a big impact. And lastly, I'll say, look, execution matters. The beauty of software is it doesn't really matter if you were first. Almost all the people that created all the value or captured all the value didn't show up first. They just kind of executed. And at the core of that really is culture. We have this list we do with Glassdoor, top 50 private companies, actually. Here's the top 25 and the top 25 publics. Just quick shout out to Pendo. I think Todd is somewhere in this room for being the number one on this list. So congrats, Todd, on that. Let me just kind of summarize this. So there's over 100,000 software companies in the US, according to LinkedIn. 30,000 of them have over 11 employees. Yet we all know, based on all the data we just saw, to capture any real value, you have to get to 1,000 plus. Okay, that's where most of the value is going to get captured. So that's 2% from the 32,000 and less than 1% of the 100,000 companies. So it's not an easy endpoint. It's an aspirational endpoint. But at the end of the day, that's where most of the value will get captured. But I would say that given the macro trends, given the frothy capital markets, there's never been a better time to be a software founder. The backdrop is really perfect, and there's a rising tide that all of us in this room really benefit from. And so going back to the beginning, I really think software's best days continue to be ahead of it. So I'm going to end the presentation there. 0 on the clock, by the way. That's kind of shocking. All right. Thank you. Thank you.